Understanding debt-to-equity ratio. The debt-to-equity ratio is a crucial financial metric that helps investors and analysts assess a company's financial leverage and overall risk. This document explores the debt-to-equity ratio concept, its significance, its calculation, and its implications for businesses and investors. What is the debt-to-equity ratio? The debt-to-equity ratio, DE, is a financial ratio that compares a company's total liabilities to its shareholder equity. It indicates the proportion of debt financing used to equity financing. A higher ratio suggests that a company relies more on borrowed funds, which can imply higher financial risk, while a lower ratio indicates a more conservative approach with less reliance on debt. Importance of debt-to-equity ratio. Risk assessment. Investors use the DE ratio to evaluate the risk associated with a company's capital structure. A high ratio may signal potential difficulties in meeting debt obligations, especially during economic downturns. Investment decisions. The ratio helps investors make informed decisions about investing in a company. A balanced DE ratio can indicate a healthy mix of debt and equity, which may be attractive to potential investors. Comparative analysis. The DE ratio allows for comparison between companies within the same industry. This can help identify which companies are more leveraged and potentially riskier investments. How to calculate debt-to-equity ratio? The debt-to-equity ratio is calculated using the following formula. Debt-to-equity ratio is equal to total liabilities shareholder equity. Total liabilities. This includes all of a company's debts and obligations, such as loans, bonds, and other financial liabilities. Shareholder equity. This represents the owner's claim after all liabilities have been settled, including common stock, preferred stock, and retained earnings. Implications of debt-to-equity ratio. High DE ratio. A high debt-to-equity ratio may indicate that a company is aggressively financing its growth with debt. While this can lead to higher returns during profitable periods, it also increases the risk of insolvency if the company faces financial difficulties. Low DE ratio. A low ratio suggests that a company is less reliant on debt and may be more stable during economic fluctuations. However, it could also indicate that the company is not taking full advantage of leverage to grow. Conclusion. The debt-to-equity ratio is a vital tool for evaluating a company's financial health and risk profile. Understanding this ratio can help investors make better decisions and assess the potential risks and rewards associated with investing in a company. By analyzing the DE ratio in conjunction with other financial metrics, stakeholders can gain a comprehensive view of a company's capital structure and overall financial stability.